Welcome to The Explainer. Today, we're diving into what is arguably the ultimate financial debate of our generation. On one side, you've got real estate, tangible, physical properties, stuff you can actually see, touch, and, drive past on a Sunday. And on the exact opposite side, index funds, invisible numbers on a screen, quietly doing their thing in the background. People get seriously fired up about which path is better. But today, we're cutting through all that hype.
So, what does this all mean? Which one actually builds more wealth at the end of the day? To figure this out, we aren't just going to sit here throwing around dry economic theory or cherry-pick stats. No way. Instead, we are going to track a strict 20-year chronological journey of two identical investors. We want to see exactly what happens when the rubber meets the road. All right, let's dive right in. Meet Ethan and Lucas. These guys are a perfect match. Both are 28 years old. Both pull in a solid $65,000 a year at their jobs, and, super importantly, by skipping those crazy expensive vacations and living below their means, they've both managed to save up exactly $50,000. They are standing at the exact same starting line, but they're about to sprint in totally opposite directions. Ethan, he's all in on real estate. He wants something real. Lucas, on the other hand, believes in the stock market. He wants an investment that absolutely doesn't eat up his weekends.
Ethan wastes zero time putting his money to work using leverage. He takes his entire $50,000 and drops it as a 20% down payment on a $250,000 rental house. He locks in a 30-year mortgage at 7%, which makes his monthly payment around $1,330. But here's where real estate feels like magic. He immediately finds a tenant willing to pay $1,800 a month in rent. So on paper, Ethan is walking away with an easy $470 of pure profit every single month, literally from day one. He is feeling like a real estate mogul.
Meanwhile, Lucas is taking a vastly different approach. He quietly parks his entire $50,000 into a total stock market index fund. There's no leverage here, no physical property to go inspect, and definitely zero tenants to manage. He just takes the leftover cash in his budget and sets up a boring, completely automatic transfer of $200 every single month. Once that's locked in, he literally just closes the app and goes on with his life. From the outside, on day one, Ethan looks like he's already winning. Lucas just has a confirmation email. But let's see how this actually plays out over time.
Section 1. The reality of rent.
Okay, 3 years zip by. Ethan checks his spreadsheets. On paper, he's collected roughly $64,800 in rents, and his mortgage has cost him about $47,880. That leaves nearly $17,000 in positive cash flow. Sounds amazing, right? But that number is about to violently collide with reality. Let's talk about the hidden costs, the ultimate real estate rug pull. Properties do not stay rented 100% of the time. You got to budget for at least a month of vacancy every year where you're footing the mortgage with zero income. When tenants do move out, you're paying for turnover, deep cleaning, and fresh ads. Then there's just regular maintenance. The golden rule is 1 to 2% of the property's value annually. For Ethan, that is up to $5,000 a year. Plus, you've got those big-ticket nightmares like a dying water heater. And finally, if you hire a property manager, kiss 8 to 10% of your rent goodbye. If you don't hire one, well, you're paying for it with your own free time.
It all boils down to this reality check. Rent minus mortgage is only the beginning. By year 5, Ethan's already had to slap on a new roof, deal with a 2 a.m. plumbing disaster, and eat a few vacancy months. When you subtract all those very real expenses, his actual cash-on-cash return settles down to around a respectable 3 to 5%. It's totally solid. But let's be real. It is a far cry from the easy 15 to 20% returns those internet gurus are constantly bragging about.
Section 2. The quiet power of compounding.
So while Ethan is busy taking panic late-night phone calls about leaky sinks, Lucas's invisible wealth has been doing something incredible in the background. We're at year 7 now. His initial $50,000, plus that steady drip of $200 a month, has swollen his portfolio to about $120,000. Assuming a historical long-term average market return of around 10%, his stash is scaling up fast. But the real game changer is that third element, the compound growth. By year 7, his investments are generating more money every year than his actual out-of-pocket contributions. The curve is starting to go vertical. His money is literally making its own money, and he hasn't lifted a finger.
Section 3. The 10-year check-in.
Fast forward a full decade. Now we really get to see Ethan's leverage go head-to-head with Lucas's compounding. Over 10 years, Ethan's property value went up, and he's been chipping away at that mortgage. His total equity, his net worth, is sitting somewhere between $165,000 and $200,000. Lucas
just quietly letting his automatic transfers run, is sitting at a net worth of $170,000 to $180,000. Look at that. They are incredibly close financially. Ethan might be slightly ahead if his local housing market was hot. But check out that right column. To get to this point, Ethan burned through roughly $30,000 in hidden costs and literally hundreds of hours of his life playing landlord. Lucas, 0 hours spent, just pure, unadulterated patience.
This brings us to a massive, absolutely crucial takeaway for this whole explainer. Ethan invested time. Lucas invested patience. They are building wealth at almost the exact same rate, but the personal toll is totally different. One path demands your weekends, and the other demands your discipline.
Section 4. The 20-year finish line.
Another whole decade passes. It's been 20 years, and it is time to answer our big question. For Ethan, he crosses the finish line with a total wealth of approximately $505,000. Honestly, a fantastic result. His property appreciated to around $500,000, leaving him with roughly $385,000 in built-up equity, plus about $120,000 in actual net cash flow that he managed to scrape together after every single repair and expense over 20 years. He used leverage to build over $500,000. So what about Lucas, our hands-off index fund investor? His final number is approximately $518,000. No way, right? It's a remarkably similar finish, but here is the absolute kicker. Over 2 decades, Lucas only contributed $98,000 of his own cash. That means over $420,000 of his wealth came entirely from pure compound growth. He built a $500,000 nest egg without ever holding debt, without ever replacing a roof, and without ever dealing with a single tenant.
Section 5. The real winner.
Now, looking at all that time and effort saved, you might be thinking, well, obviously stocks are the clear winner. Actually, scratch that. We're forgetting a massive, unseen toll on the stock side. The brutal, gut-wrenching reality of market volatility. See, when things got tough, Ethan could drive by his house and physically see that it was still standing. Stock investors? They pay in pure psychological stress. In 2008, broad indexes fell by nearly 40%. In early 2020, they plunged more than 30% in a matter of weeks. Imagine opening your phone and watching half of your hard-earned life savings just vaporize overnight. It takes an iron stomach not to panic and sell the whole shebang. It is psychologically devastating in a way that physical real estate just isn't.
So what are the real trade-offs here? Because neither path is flawless. Real estate gives you that amazing superpower of leverage for sure, but you take on heavy concentration risk, literally putting all your eggs in one neighborhood's basket, plus a ton of debt and a serious time commitment. Index funds, conversely, ask for 0 of your time, but you have to endure terrifying roller coaster market drops, you get very little monthly income from dividends, and you don't get to use leverage to supercharge your starting cash. The right investment isn't a math equation. It strictly depends on your goals and your personal temperament.
So the next time someone corners you at a party and insists that real estate definitively beats the stock market or vice versa, I want you to hit them with one simple question. Did you include everything? Because the only answer that genuinely matters is the one that factors in all the hidden costs. Your time, your stress, your tolerance for risk, and yes, your money. Think about what kind of daily life you actually want to live and pick your path from there. Thanks so much for joining me for this explainer, and here's to crushing it on your own wealth building.